Welcome back to Tokenization 101. I'm Kora. In our last episode, we explored the differences between venture capital and tokenization, highlighting how token models can unlock new, inclusive pathways to fund innovation. Today, we're turning our focus to a major pillar of traditional finance, the initial public offering, or IPO. For decades, IPOs have been the gold standard for raising capital at scale, the moment a company goes public and sells shares to investors on a stock exchange. But in a world of programmable assets, global connectivity, and real-time transparency, does this model still serve the needs of modern founders and investors? What happens when we compare IPOs to tokenization? Let's break it down. An IPO is when a private company offers its shares to the public for the first time. It's the result of years, sometimes decades, of building, fundraising, and growth. Here's how the process typically works. A company hires investment banks to underwrite the IPO. A valuation is determined based on revenues, projections, and market demand. A detailed prospectus is filed with regulators, like the SEC in the U.S. The company embarks on a roadshow to pitch to institutional investors. On IPO day, shares are sold to the public via a stock exchange. The benefits? Massive capital influx, sometimes billions in a single day. Liquidity for early investors and founders. Increased public visibility and prestige. But the costs? Months of preparation and millions in underwriting fees. Ongoing regulatory compliance and quarterly reporting. Pressure to deliver short-term shareholder value, often at the expense of long-term vision. Going public is powerful, but it's also expensive, rigid, and increasingly out of reach for smaller companies or emerging market startups. Now, imagine a similar outcome. Public access to your project or product, but with lower friction, fewer intermediaries, and programmable rules. This is the promise of tokenization. Instead of listing shares on a stock exchange, a company could issue digital tokens on a blockchain. Each token could represent access rights, future revenue, usage credits, or even governance powers. These tokens are sold directly to a global audience, through mechanisms like token sales, DEOs, or regulated offerings. Participants can verify the terms on-chain and track performance in real time. Unlike IPOs, tokenization doesn't require gatekeepers like investment banks or traditional exchanges. You can issue, distribute, and track everything using smart contracts. This creates the possibility of a programmable public offering, one that can adapt to your business model, community, and compliance needs. Let's compare both models across the factors that matter most. Access and inclusion. IPOs are dominated by institutional investors. Retail buyers often come in later, and at higher prices. Tokenization can allow earlier access to a broader set of participants, including community members, users, and global investors. Speed and cost. IPOs can take 6 to 12 months and cost millions in legal and banking fees. Tokenization can be significantly faster and cheaper, especially when done under a regulatory sandbox or compliant framework. Liquidity. IPO shares are traded on stock exchanges, but often have lockup periods for early holders. Tokens may be tradable sooner, offering 24/7 liquidity on decentralized or regulated exchanges, subject to compliance. Transparency. IPOs require quarterly reports and limited disclosures. Tokenized models can offer real-time reporting through smart contracts and on-chain data. Governance. IPO shareholders may vote, but proxy voting is complex and delayed. Tokenization allows for on-chain governance, transparent, auditable, and fast. Global reach. IPOs are often limited to domestic markets or select international buyers. Tokens are borderless by design, reaching investors around the world within regulatory limits. Let's say you operate a renewable energy startup in Brazil. You want to raise $10 million to expand solar infrastructure across underserved regions. Option A, IPO. You'd need to reach significant scale first. You'd hire banks, lawyers, and accountants. You'd file with the Brazilian Securities Authority, or list abroad if you qualify. You'd need years of audited financials, a strong board, and investor demand. Realistically, it might take a decade, or never happen. Option B, tokenization. You issue a token that grants rights to carbon credits, usage of solar infrastructure, or a share of renewable output. You structure it under Brazil's regulatory sandbox or with FSCA oversight in South Africa. You fund the expansion, reward your early supporters, and align token value with energy output. Now your community holds value in the success of your impact, and you retain flexibility and control. Tokenization is not a shortcut to avoid regulation. If your token behaves like a security, offering profit based on the efforts of others, it will likely be regulated as such. You'll still need legal guidance on Reg D, USA, MiCA, EU, or FSCA, South Africa, smart contract auditing, secure token custody, transparent communications and disclosures. In other words, responsible tokenization follows the law and builds trust through compliance and transparency. Interestingly, the future might not be either or, but both. We're starting to see tokenized IPOs, where companies issue equity and utility tokens in parallel digital share registers, replacing paper-based stock systems, exchange-integrated smart contracts, to automate dividends and voting. Imagine a future where you invest in a company's equity via IPO. You also hold tokens for product access or governance. The value of your investment evolves in real time, with full transparency. This hybrid model brings the credibility of public markets and the flexibility of token ecosystems. The IPO has played a vital role in modern capitalism. It helped scale companies, reward founders, and build shareholder wealth. But it wasn't built for a programmable, real-time global internet. Tokenization offers a new framework, one where capital is raised inclusively, participation is aligned with product value, ownership and usage can coexist. It's not a replacement, but an evolution. For founders, builders, and investors worldwide, tokenization is opening the doors to a new kind of public market. In our next episode, we'll unpack how tokenization works step by step, from asset selection to smart contract deployment. I'm Kora, and this is Tokenization 101. See you in episode 8.